Tim Horan, let's go around the bond world as we head into 2016. And let's start off with the Fed because it's a huge Fed week. So what does a quarter-point hike mean in the bond world? How big is it?
Greg, this was a moment of credibility catch-up for Janet Yellen, and at last she's made the move, and markets need to take that on board, that we have a new paradigm, a paradigm of gradualism. And now it's going to be a case of each segment of the bond market reacting to the data points as they emerge over time, because that's going to dictate the pace of the next rate move. So it wasn't just about these 25 basis points. It's now about the whole life cycle of rate normalization. So it's going to be an exciting time, I think, for bond investors.
Well, it's certainly an exciting time in the high yield market. The problems at the Third Avenue Fund has certainly unnerved the high yield market. Is this an isolated incident?
It's a Darwinian moment. The weaker in the high yield market are likely to get weaker here. The stronger are likely to get stronger. So as investors, I think you want to be very, very careful in allocating more risk units to high yield at this point. It looks very attractive just from a pure yield basis. We've had a spread widening here. And so I think risk units in 2016 need to look very carefully and gravitate to parts of high yield, but look for the strength, not for the weaker players.
Well, the muni market has been fairly steady in 2015, some solid results there as the states have gotten their fiscal houses in order. What do you expect for 2016? Another solid year?
We like munis, and we think that they're going to perform well next year. We've already seen, as you mentioned, better balance sheets for a number of states, with the exception perhaps of Puerto Rico here, which is still going to have problems in 2016. But as an asset class, we think that it's a good place for people to allocate risk units in 2016.
Do you expect a lot of issuance in 2016 in muni land because it was not that big in terms of munis? Bigger in corporates, but we'll talk about them in a second.
I think that's going to be dependent on state treasurers getting out there in front of the next Fed move and deciding we don't want to pay more to issue. You're absolutely right. We need more issuance at this point in the muni market. The muni market's down to a visible supply of about $5 billion at this point. That's pretty low to end the year.
All right, let's talk about investable grade corporates now. There was a lot of issuance there. You even saw Apple and Microsoft come to market just because rates were low and they could raise money. So what's your expectations for this part of the bond market in 2016?
Well, it's been a party on year. A lot of treasurers in corporate investment grade have been out there taking advantage of the appetite. I think it's going to be a good solid year because I think those corporate treasurers are also going to get in front of the next rate moves. And also there's going to be a demand, an international demand that's going to come in. We saw earlier this year how the gravitational effect of European interest rates being in a negative territory has brought investors from Europe into our investment grade market. I think they're going to be back in the new year, and particularly with the prospect of a declining euro versus the dollar.
And do U.S. investors want to buy European or Asian bonds?
Right now, I don't think that a negative yield in Europe really presents much opportunity, and also with weakening currencies in Europe. But going forward, I think we need to look very carefully as to where within the developing world we might see some point of attraction of higher yields and perhaps some stabilization in developing markets. The weakness there this year has been driven by weak commodity prices and also just weak demand in their economies.
All right, and bringing it all back home, where do you see the 10-year Treasury at the end of 2016? And you'll come back and we'll talk about that next year at this time.
We'd love to come back and talk about it. Right now, my best expectation is that we are going to see some higher yields, but it's going to be tough. I'm expecting more of a curve flattening to take place, so we will have a move up in the front end of the market, but the longer end I think is going to stay pretty well behaved. So my expectation is somewhere between 265, 285 for the 10-year for next year.
All right, well, we're going to have you back before next December. Thanks for coming on today, Tim Horan.
Thanks very much.
And thank you for watching The Street.